content, information, and opinions expressed during the related show are those of the show personalities and guest alone, and not those of Vic Canellis Media Group, its parent, affiliates, or stations. VCMG Live is not responsible for any content, information, or opinions expressed. User bears full responsibility for their reliance on such content, information, or opinions.
Welcome to Making Money with Laura Sanders, a name you can trust. With over 20 years of real estate experience and selling over 150 homes a year, Laura Sanders is the #1 RE/MAX agent in the state of Florida for 2021. Join us each week as we discuss how to make money through buying and flipping homes, to renting versus selling, and everything in between. To join the conversation, call in live. 888-994-4995, Studio A.
Hi everyone, welcome to Making Money with Laura Sanders, and I am your host, Laura Sanders. Every week we talk about something that will help you make a little money, save a little money, or maybe just help you navigate the crazy world that we live in. Today we're going to talk about inheritable flood policies, and then we're going to also talk about insurance and why some carriers, or I should say not carriers, but some insurance agents will write cheaper policies than others. So welcome, Brandon from Goosehead Insurance.
Thanks for having me.
How are you?
First show after your 2-year anniversary. That's exciting.
Yes.
So on to year number 3.
Yes, on to year number 3. So let's talk about insurance, and let's talk about first, I know that recently you had given a quote to a client, and yours was a little bit higher than another carrier's. I say carrier, and I got to make sure I'm clear, because a carrier is really not what you are. You're an insurance agent.
Correct, a broker.
Right, a broker. So why is that sometimes?
This is a really, really good question, and ties into fraud a little bit, so I'll talk about that. But what happens is as insurance agents, we go out and we shop with a bunch of different carriers that actually hold the liability of the policy. And when we go shop those policies, we are looking at the property itself and the characteristics of that property. And the main coverage is what we call coverage A, or dwelling coverage. And that dwelling coverage is the max the insurance company will pay out to rebuild the property in the event of a claim. Now, there's one exception there, but we'll skip over that today. We've talked about that in the past. But that number is not arbitrary. So if it's $487,300,
And that's from an estimator. They put it into a
correct.
program.
So what we do is we take this property and we take all the details of this property and put it into what's called a replacement cost estimator, or an RCE. And that estimates the cost to replace the structure itself.
Right, because the land never loses the value.
Correct.
It stays the same.
Now, what happens with that is some agents try to get that replacement cost estimator number, which is equivalent to the dwelling amount, as low as possible so they can win the policy. Some will put it over. The way that I like to do things is the right way. And I look at the property appraiser's website, which isn't always right. And I also pay for the MLS, so what realtors use, to get as much data as I can about the property. And I plug it into that replacement cost estimator. Now, that replacement cost estimator, it is very specific. It gets very granular.
Like?
So it's going to look at the big things: the shape of the property, the roof type, the square footage, so on and so forth. But it's also going to look at what kind of countertops do you have? What kind of cabinets do you have? What kind of bathrooms do you have? What kind of finishes? Do you have paint? Do you have plaster? Do you have wood paneling? It can get as specific as that. And so if that is not done correctly, what happens is the insurance carrier will sell the policy, everything will go through, the person will close if they're buying a house.
Okay.
The carrier will underwrite the file. They're going to double check that replacement cost estimator.
So they don't do it before they close.
They don't do it before they close. They wait.
That's kind of scary.
Well, there's only so much time.
Right.
And so they double check it, and then it comes back and they say, hey, you didn't add on here that there was a 400 square foot porch. You need to make sure, we're going to add it for you. Now the premium's going up $500 a year.
So this is making sense to me now. So, funny story, as I digress for you just for a second. So I just got in the mail, okay, here's something. I just got in the mail that I don't have enough coverage on one of my properties. But the funny thing is that when the insurance agent did the property, it was horrific. I think you were just at the property.
Okay.
It's pretty in the back, right?
Yeah, it's
you
really
should have
nice.
seen what it was before. Ugh.
Yeah.
Right? Well, I guess about maybe 2 months ago, I got a call from the insurance company saying that we needed to come out to look at the property. And they needed to gain access just to the backyard.
Well,
And then they saw how great it looked versus the pictures from when I originally
Yeah.
bought it. And now they said that I'm underinsured
underinsured.
and I have to bring it up.
Correct. So most carriers require that the property is insured to 100% of replacement cost value.
But here's what's funny though, and I'm kind of just because, you know,
Let's do
obviously
it.
I'm taking this into real
Yeah.
life. I was just looking at my taxes, and my taxes, believe it or not, the taxes went backwards $1,000. So that's kind of weird too, right?
Yeah, but the way that the property appraiser gets the assessed value, I don't understand. I would love to have a show with Marty Carr.
We've done that, and we can do that again.
Yeah, I would love to be there. I'd love to meet him and just pick his brain because I don't really understand that.
Right.
But we're looking at the assessed value. Now, the assessed value on my house hasn't changed, but I put a lot of money into our house
But that's on the inside, right?
on the inside.
Can't see it on the outside.
No, you can't. And so
Because they see everything from
hopefully
aerial.
they're not hearing the show and then they go raise my taxes.
We didn't say your last name. You're okay.
So yeah, I mean, it all comes down to that, what the characteristics of the property. And I've seen, I'm not kidding. There was a property in Margate, which is like the nicer area of Margate, close to Coral Springs, that my replacement cost, it was a big house, came back around like, I want to say it was like 400, 450.
Okay.
The client was shopping around. They got a policy out of somewhere in Miami. The replacement cost was like 275. And I said, listen, man, you do what you want to go with, but I promise you this is going to get kicked back.
And how did you find out it did get kicked back?
I never talked to him again, but I know that it did because I know Citizens is going to.
So you should follow back up with the guy and be like, hey, now don't you want somebody that's going to do it right so you don't have to worry about dealing with this after? Because it's a mess to deal with it afterwards.
It's a mess. So like I told you, those policies, if you find a cheaper policy and
not
the
always
replacement
better.
cost is much lower than mine, I know what I'm doing is right. And I don't say that from like a boastful point of view. But if somebody's going to give you a policy that's not good and you want to go with it, I'm okay losing that business. Because what's going to happen is it's going to come back, it's going to create frustration for the client, it's going to create more work for me in my team that it's not worth it.
Right.
It's not worth it. So we want to make sure that that replacement cost estimator is correct.
So how do you guys get paid?
So we get paid, it gets a little bit complicated depending on the carrier, which is my favorite answer. It all depends on the carrier.
Right.
But we get paid a commission, just like real estate.
But let's say something like that gets kicked back, right?
Uh-huh.
And they get canceled. Do you have to pay it back?
With life insurance, you do. With mortgages, after 6 months,
Before 6 months.
they
Six,
do.
7, really, I guess. It has to be a full 6, right?
So with us, typically we don't have to pay it back. I have a team that handles like the finance side.
So why
for
don't
me.
you just write it then
So
and take the risk like the other people and let them come back?
because the person gets frustrated, and I'm not really interested in doing business to make people frustrated. I want to do business with people that they're going to refer me to other people and they're going to have a good relationship with me, not just, oh, this guy got me the lowest price and then it became a sham. I mean, look at the insurance industry as a whole. People are frustrated with it.
It's getting bad, yeah.
People are so frustrated. And so the way that I run my business is with that in mind,
Right,
because I don't want people to be frustrated. And if I lose some business to that, that's okay.
right. So we're going to come back and we're going to talk about inherited insurance.
Flood,
I
Laura.
don't know why that's a problem. When I come back, we're going to go to commercial break, and when we come back, we're going to talk about inherited flood policies and what that's all about. Stay tuned and check out our awesome sponsors.
Whether you're buying, selling, refinancing, or building your dream home, you have a lot riding on your loan specialist. Max Fish, a top 1% mortgage loan officer in the nation, will give you a same-day qualifying quote. Max Fish is committed to providing his customers with mortgage services that exceed their expectations. Ensuring that you make the right choice for you and your family is his ultimate goal. Contact Max Fish today at 954-729-6933 or max.fisch@nwmcorp.net.
At JK Closing Attorneys, we do all of the same things that a title company does, but with the benefits of being a law office. We can help with residential real estate, short sales, commercial real estate, refinances, 1031 exchanges, and FRIPTA withholding.
Contact JK Closing Attorneys today at 954-332-3111. Again, that is 954-332-3111.
You have been watching Making Money with Laura. For more information, contact Laura Sanders at 954-650-0827 or visit her website at theloracell.com. And now back to the show.
Welcome back to Making Money with Laura Sanders, and I am your host, Laura Sanders. Today we're talking about insurance and why some insurance companies write policies for less money and then those get kicked back. So why wouldn't Brandon do that? And he's telling us that he's an honest person, he's not going to do that. And then we're going to talk about inherited flood policies, which is something I have to tell you I learned about many, many years ago when selling a property on Young Circle. And let me just tell you what that policy was. $18,000. Wow. But before we get into that, I first want to tell you how you can get a hold of me if you're thinking about buying or selling a home, or you just need the perfect referral for yourself, for a great mortgage, for insurance, for a title, any of those things. You can give me a call at 954-650-0827. Laura Sanders, RE/MAX Direct. Also, I have been the #1 RE/MAX agent in the state of Florida, on and off for the last 7 years, but always in the top 3. Brandon, what's a great way to get a hold of you?
Best phone number is 954-326-9842.
So we're going to talk about inherited flood policies.
Yes. So it's important to start with, there are 2 types of flood policies for the most part.
Okay.
There's what we call the public or government market, the federal flood policy program, and then private flood policies. This is not including private flood policies. Now, the National Flood Insurance Program, which is run by FEMA,
okay,
they have a map, they say what flood zones are, so on and so forth. Well, those policies have something on it called a statutory discount. And it's the easiest thing I can liken it to for the average homeowner or someone buying a home is homestead exemption. On homestead exemption, you have the Save Our Homes cap. It can only go up 3% a year. It's similar with this. They give a discount that as long as you are renewing your flood policy, you're going to get a discount.
Okay.
Now, these policies are inheritable. Not the policy itself, but the statutory discount. Okay. So I'll give you an example. I had a lender and a realtor out of Miami this past week call me. They're trying to get the best numbers for this property so they could close. We found a policy that works great. And then they said, it's in a flood zone. We have to have flood. So how can we add this to make sure the ratios work and everything for the loan? And I said, well, does the seller have a flood policy? It was actually the listing agent contacting me to make sure the deal would go through.
Which we should always do, which I
So
do.
their other flood quote was around I want to say it was $3,300 for the year.
Oh, it's a lot of money.
And I asked, does the seller have a flood policy? They did. I was able to get that statutory discount, and so it ended up being around $1,800.
Which is a big savings.
Big savings. Now, another story I like to share, it's my favorite flood story.
Okay.
There's a client I have in Marco Island, which Marco Island is the most expensive flood.
Really?
It's really, because it's an island.
Okay.
So the flood policies there are really, really expensive. Well, this guy had flood insurance for a really long time, and he was switching from a different broker to me, and he told me that his flood policy didn't get paid. It actually ended up getting paid, but so I had to rewrite his flood policy as a new policy without the statutory discount. It went, I think his flood was $1,800. It wasn't bad at all. Went up to 12 grand.
So wait a minute, you couldn't go back to his other policy?
Because he missed the payment, sometimes you can. I think I've figured out a way that you can. But he ended up not missing the payment. But let's just say, for all intents and purposes of this conversation,
That he did.
if he did and he wasn't able to go back, it was going to go up to 12 grand. He would have lost
So
that
are
statutory
you
discount.
protected by a certain percentage?
With flood policies? It's a
Like
good-
you are with insurance? I mean, with taxes,
with
sorry,
taxes. That's a good question. I don't know how they come up with how they create the statutory discount. It's a really good question. I should look into that. With Save Our Homes, it's only going to go up 3%. You know what that is.
On your homestead, but.
Correct.
But if it's your investment, it's 10%,
Yeah. So
which is great too. I mean, it's better than 100%.
yeah, that's true. So with the statutory discount on flood, I don't know that answer. It's a good question.
Okay. And you were talking about private floods, so tell us a little more about that.
Yeah, so the National Flood Insurance Program through FEMA, they're going to cap out at $250,000 in coverage.
Okay.
It's the max that they're going to give. But that's actually really good because people that are getting a mortgage and they're tight on ratios, the mortgage companies will allow for that $250,000 in coverage. They'll be satisfied with that because it's the National Flood Insurance Program.
Okay.
So that helps out a lot of people that they don't have to go, let's say their dwelling coverage is 100 grand. The mortgage isn't going to say, oh, you need 500 grand for, 500 grand, you need 500 grand in flood also. They're going to say 250 is okay. So that's the important thing. Now the private market, one, it's private. It's not government. Dealing with claims, every attorney I've talked to dealing with claims through National Flood Insurance Program is night and day compared to a private company. Way different, just like Citizens. Citizens is state-backed. You're going to deal with a lot more red tape in any government program that you're looking at or policy. So the second thing is that private, they offer a lot more ancillary coverages. So like temporary living expenses. My house
so
flooded.
they don't have that in.
It's not
Yeah.
explicitly stated. And so you can try to get it, but again, you're dealing with red tape. So like,
I don't know. I heard from people when Fort Lauderdale had that flood. I know some people, they got no living expenses.
yeah, so you can hire an attorney and try, but you pay for insurance for peace of mind. Well, with the private policies, you can pay for temporary living expenses of 10 or 20 grand. You can pay for pool pop-up coverage,
Oh my God.
which that's a real thing.
I know.
If water, the ground gets too saturated, pools can pop up. It's happened. Go Google it. It's really cool.
I guess I'm going to be Googling it now because I want to see what that, I mean,
Yeah.
not that I want that to happen. I just be curious to see what does that look like. I mean,
Yeah.
these are the things you just don't think about.
Yeah, and there's a lot of ancillary coverages that are on there that can really make or break it. Especially, my big thing with temporary living expenses is families. Because if you have, 2 or 3 kids and you don't have in-laws that live in the area that you can go to, or you just don't want to,
Yeah.
you gotta go
can't-
somewhere.
But if you've had water damage, you can't live in mold.
Exactly. So my biggest thing with temporary living expenses or additional living expenses is
So
families.
what would a policy like that look like?
Well, if you're not in a special flood hazard area, it's usually pretty similar in cost, apples to apples, as the National Flood Insurance Program.
But what if you are in a flood zone?
If you're in a flood zone, usually National Flood Insurance is the way to go. It's usually much cheaper. But some people say, okay, I'll pay the extra $4 or $5, $1,000, $1,500, for the private flood.
So you have extra coverage.
Yeah.
So,
Now, the other thing is on the private is that they'll go above 250. They'll go far above 250. If you need $1 million in coverage, they'll do it. If you buy the National Flood Insurance Program policy, they're going to cap at 250, and then you have to buy what's called an excess flood policy, which is going to go above 250.
I tell you what, it's like you got so many different schools of thought. People are like, oh, I don't want to have insurance. I do want to have insurance. I want to self-insure. I mean, it's kind of scary.
It's a lot. It's a lot. But the most important thing to do, and I tell people this every day, Laura, and I really believe this, is we want to look at our decisions based on data.
But the data that we saw, like North Carolina, that data was not there, and now look.
Correct. But in Florida, we have pretty good data for hurricanes and flood. So, you know.
But you're seeing things that have happened. It's funny, Fort Lauderdale got hit twice in like a 2-3 year period of time where it never had gotten hit for 100 years. Like,
correct.
Kind of crazy
Correct.
stuff.
Yeah, there is crazy stuff that happens. But I don't just say data as far as historical weather data. But, you know, data as of the likelihood of a new roof versus an old roof getting damaged.
Right.
You know, if you have a new roof, go with the higher deductible. It's probably not going to get damaged. If you have an old roof, go with the lower deductible. If you're going to use your hurricane deductible for anything, it's going to be the roof. And so the reason I say that looking at the data is because I try to help my clients. I don't want to sell them. I want them to make the decision that's best for them and their family when it comes to coverage, because they have the choice. Most agents just send a quote and hope it sticks. But I'll go over the quote with them. You decide, and we don't want to just make an emotional peace of mind decision, but also make a financial decision, and that's where the data comes in.
So one last thing, because I know we're running out of time. One thing that I want to talk about, and I had asked you this question. I had asked you on one of my properties that if I got a new roof, would I save any money? And I'm getting so tired of this. Every time I'm like talking with somebody, and I think they're frustrated with me as much as I'm frustrated with them when they say, oh, well, a roof's over 20 years, you know. It's like, if it's not leaking, why are you going to fix it?
Really, really, really good question. And what's my favorite answer?
It depends on the
Depends on the
carrier.
carrier. It really does depend on the carrier. So a couple things with this is,
If it's over 20 years, there's not as many carriers, right?
well, one,
The house itself.
people generally take their experience with their insurance company or their insurance carrier and they superimpose it over everyone. So if let's say insurance carrier C says, we don't insure roofs over 15 years old. Well, then they'll tell their friends, well, insurance companies aren't insuring roofs over 15 years old. It's not necessarily the case. So what happens is one, you can't superimpose, but it really depends on the carriers. Citizens doesn't rate based on the age of the roof. So they're not going to give a cheaper price if it's a 2024 roof or if it's a 2000 roof. Okay. It's not going to make a difference. But other insurance companies are going
But
to.
then to say, oh, I'm not going to get insurance because it's over 20 years is BS.
Correct. Like Citizens on a hard roof, so a metal or tile roof, they'll go up to 50 years.
Really?
On soft roofs, they'll go up to 25 years. Now, other companies...
I need you to say that one more time into the, because I'm just so tired of having this conversation with people, and they're like, well, and I'm like, you tell me what you would do. If you were going to save $1,300 a year if you got a new roof, would you do it if your roof was 20 years old?
What kind of
Tile.
roof? No, I wouldn't do it.
What I say.
Because...
And I look like I'm the...
Now, again, I look at this data-driven. I worked on roofs in high school and college. I know how to repair roofs. I know what goes on up there.
I have some stuff for you to do.
I've got a really good guy. Most tile roofs, an inspector is going to give 25 to 35 years of life. Now, a lot of roofers may give less because they want to sell the job. Let's be honest.
Right.
But I would say most roofs are going to get tile roofs are going to get 30 to 35 years. So for me,
I'm closing one right now, 1992.
For me, 20 years on a tile roof, I wouldn't replace it.
I wouldn't either.
I would go with the lower hurricane deductible, but I wouldn't replace the roof.
Okay. Well, if you're thinking about buying or selling, definitely give me a call. My name's Laura Sanders with RE/MAX Direct. You can always reach me at 954-650-0827, or you can go to my website at laurasell.com. That's right, I couldn't afford the S, so it's laurasell.com. not cells. What's a good way to reach you, Brandon?
Call me on my cell phone anytime, 954-326-9842.
Okay. And any last words of wisdom before we sign off today?
I could just go on for hours about insurance.
I heard about that.
I wonder where you heard that from.
Anyway, thank you for watching Making Money with Laura. Till next week, we'll see you then.
Thank you for tuning in for Making Money with Laura Sanders, a name you can trust. To join the conversation, call us at the studio, 888-994-4995 Studio A, or contact Laura directly at 954-650-0827. Laura Sanders, a name you can trust. We look forward to seeing you next week.